The unseen forces shaping the gaming landscape, a deep dive into tariffs, inflation, and the future of profitability. In an unprecedented turn of events, the gaming industry finds itself grappling with seismic shifts that are redefining the rules of the game. Sony's decision to hike the PlayStation 5's price tag by $50 across all models, a first since its launch in 2020, serves as a stark indicator of the economic pressures mounting within the sector. But here's where it gets controversial. This move, spurred by U.S. tariffs on Japanese electronics, global inflation, and supply chain woes, reveals a paradigm shift in how hardware manufacturers are weathering the storm. And this the part most people miss. For investors, it's not just about hardware margins anymore. It's about recognizing the strength of digital and subscription-based models. The tariff impact and the price of play. At the heart of the storm are the U.S. tariffs on Japanese electronics, currently set at 15% for PlayStation 5 components. These tariffs, a remnant of Trump-era trade policies, have placed Sony in a precarious position, forcing the company to either absorb escalating costs or pass them on to consumers. Both options chipping away at profit margins. Despite efforts to diversify production beyond China, the combined effects of tariffs, inflation, and fluctuating currencies have rendered pre-2025 pricing unsustainable. Microsoft and Nintendo haven't been immune either, with both raising the prices of their Xbox and Switch consoles by $80 to $100 respectively, a collective response to shared economic strains. The outcome? A staggering 25% increase in PlayStation 5 prices in the U.S. since 2020, with international markets experiencing even more significant hikes. For Sony, this move represents a strategic, albeit bitter pill to swallow. The company's Q1 2025 financial report paints a telling picture. While hardware sales saw a mild 4.2% uptick, operating income for the Games and Network Services division skyrocketed by 127% to 148 billion yen, $1 billion. This disparity highlights a crucial shift. Hardware is no longer the main profit driver. Emerging trends, the power of digital and subscriptions beneath the surface. Sony's financials hint at a broader industry transformation. Digital software sales witnessed a remarkable 40.6% year-over-year growth in Q1 2025, coupled with an 8.3% increase in PlayStation Plus subscriptions. These segments, characterized by recurring revenue and higher margins, are proving to be far more robust than the one-off nature of hardware sales. The PlayStation Network now boasts an impressive 123 million active users, marking a 6% rise from 2024, emphasizing the platform's enduring appeal. Investors would be wise to pay attention to the inherent advantages of these segments. Cloud gaming, for example, is witnessing explosive growth. Sony's introduction of 400 PS5 titles to its PS Plus premium library in March 2025 has cemented its position as a frontrunner in this arena. The global cloud gaming market is forecasted to expand at a 22.28% compound annual growth rate, CAGR, reaching a staggering $28.6 billion by 2030, according to Statista. This expansion is fueled by advancements in 5G infrastructure and the emergence of the Netflix of games model, prioritizing accessibility over hardware. Subscription services like Xbox Game Pass, with 34 million subscribers, and PlayStation Plus are revolutionizing monetization strategies. These platforms offer a steady flow of revenue, shielding companies from the turbulence of hardware sales cycles. Sony's tiered PlayStation Plus approach, including a $9.99 per month extra tier with a dynamic game library, mirrors Microsoft's strategy and taps into the estimated 43.7% CAGR for cloud gaming by 2032. Diversification and long-term gains. Sony's transition towards a platform-centric business model, emphasizing user engagement, community, and content, mirrors a wider industry trend. The company's 15% year-over-year growth in first-party titles, such as God of War and Ghost of Yote, alongside a 22.9% surge in third-party software sales, showcases the value of a diversified portfolio. Moreover, Sony's emphasis on live service games, such as Helldivers 2 and Destiny, and cross-platform releases is fostering user retention and monetization opportunities. The message for investors is crystal clear. The future of gaming rests on resilient, high-margin segments. While hardware margins face headwinds, digital content, subscriptions, and cloud gaming are paving new paths for expansion. Sony's adeptness in balancing these priorities, adjusting console prices while investing in software and services, sets it apart as a trailblazer for the sector's evolution. Conclusion: adapting to the new economic reality, the gaming industry stands at a pivotal juncture. The convergence of rising tariffs, inflation, and supply chain disruptions has compelled hardware manufacturers to reassess their pricing tactics. Yet, these challenges have also catalyzed the migration towards digital and subscription-based models. For Sony, navigating this delicate equilibrium involves managing costs effectively while capitalizing on high-margin opportunities. Investors should zero in on companies, akin to Sony, that leverage their ecosystems to generate sticky, recurring revenue streams. Cloud gaming especially presents a promising long-term prospect, bolstered by infrastructure advancements and 5G adoption. As the industry adjusts to this new normal, those who prioritize resilience over fleeting hardware gains are poised to emerge victorious. What do you think about the industry's shift towards digital and subscription models? Share your insights in the comments below.